It's the Paradise Podcast.
I am your host, Ryan Michelle Bethay, with my husband, Sterling.
What's up?
Join us here on Hulu and Hulu on Disney Plus, where we'll discuss each episode with the cast and crew of Paradise. I'll be getting all the secrets from Dan Fogelman, James Marsden, Shailene Woodley, Julianne Nicholson, and Sterling Kelby Brown. Woo! Paradise, the official podcast, is now streaming.
And stream Paradise on Hulu and Hulu on Disney Plus.
It is Monday, and you know what happens on Monday. Normally I say, let's raise our glasses and salute our troops. But guys, I feel naked. I don't have a glass. Well, what do you do when you need to salute the troops and you don't have a glass?
You have to do 1,000 burpees.
Or I can go get a glass. Would that be better?
Nope.
Would that be
1,000
better?
burpees.
Look at the time.
It's your opportunity, soldier.
Yeah, I think we just put our hand in the air and go, hey, troops, on behalf of the men and women making podcasts in Mom's basement and all those stackers out there trying to do their thing, thank you for keeping us safe all weekend. Let's go stack some Benjamins.
Stack them. Stack them. Let's get some stacking going.
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and I've got 3-1 odds that you're gonna love today's episode. Today, we tackle betting with your money and how to turn those bets into powerful money moves. We'll start out with a recent piece from the Wall Street Journal about a huge uptick in aggressive investing and prognosticate, that's a big word, on where that might end up. But we'll also look at other assets and talk about betting on those investments. How would those work in your portfolio? But that's not all. We'll also share a TikTok minute featuring motivational speaker Tony Horsemouth Robbins, and then I'll motivate you with some of my incredible trivia. And now, two guys who were motivated enough to put pants on this morning. It's Joe and O, G.
You know I'm motivated when I'm even wearing pants. Hey, everybody, happy Monday. Welcome back to the Stacking Benjamin Show. Sit back, relax. You found us. Grab your favorite beverage and your favorite place to take notes because we're diving into your investments today. It seems like some people are investing, well, maybe a little differently than we would recommend. We'll get into that in a minute. But first, we're going to get into introducing you to the gentleman across the card table from me. Mr. OG is here. How are you, dude?
I'm in the middle of trying to transfer one iPhone to another iPhone, but otherwise I'm doing great.
To do that, do you go in the transfer portal? Do you have like the iPhone transfer
iPhones
portal?
are in the transfer portal right now. Yeah. They're negotiating for starting positions at a D3 school.
I'll be taking my talents to an iPhone 17.
Yes.
Did you see, I was listening to a podcast the other day and sports fans, this is actually about money. Even if you're not a sports fan, this is about money. And I didn't know we were going to talk about this, but on the Rich Eisen show, they were talking about how there are still 1,200 kids in the portal, 1,200 athletes in the portal. The reason they went in the portal was because some well-meaning adult was like, dude, you need to get paid. You need to get more money. There are maybe, one of this analyst said, there may be 700 or 800 college athletes that ended their career with that decision.
It's not like they don't get picked up and, well, I'll just go back to my old team.
Yeah, you're done.
Good chance they're like, no, we found somebody better.
Yeah, you are done. So the money train, as it were, might not be as flowing with cash for everybody as people originally thought.
One way to learn a lesson in college.
It is a tough lesson. The grass, believe it or not, is not always greener. We're going to actually talk about that today when it comes to investments, about investing in your portfolio, what you choose to invest in. To some degree, even if it's an investment that makes sense. We call it an investment when the odds are so stacked in your favor that we think it's worth putting your hard-earned money toward. We call it a bet when it's based on our gut. However, even an investment to a very, very tiny degree is just a well-researched, well-reasoned bet. So we're going to talk about a recent Wall Street Journal piece that talks about that today. Before we get to that, though, I got to tell you what was really cool when I went into our new product, the Vault. I immediately put my phone number in, and it told me that my phone number was on the dark web starting in August of 2024. So all these people that are writing me, Doug, going, hey, you coming over for lunch? Hey, are we still getting together later? That I'm answering because I'm all excited because I have all these friends that I didn't even know that I had. Well, it turns out that those weren't really friends of mine, and they were just trying to rip me off. Who knew? Who knew?
Back to reality. You've still got 1.5 friends.
Yes.
Plus the person from Firehouse.
and the person from Firehouse Subs. That's a story we may tell you about later, because sadly, my phone thinks I live at Firehouse Subs.
So does your waistline.
Siri, give me directions to my house.
I don't like Firehouse Subs. Your waistline says that is a lie. Right. StackyBenjamins.com/vault to see how our product, the Vault, works. It's your bedrock piece of your financial plan. It is the privacy manager, subscription manager, and your credit monitoring superpower. It really is. It does 15 things, does it all in one place. StackyBenjamins.com/vault. Put all of your safety in the Vault. StackyBenjamins.com/vault gets you there. We got a couple more sponsors who help us keep on keeping on. We're going to hear from them. And then we are diving into betting on your money in just a minute. Spring cleaning's made its way to my closet. This time of year always makes me rethink exactly what's in my closet. Really want to keep fewer things, but I also want to keep better ones. I want to feel confident, and to feel confident, looking the part's a big piece of that. So I want pieces that are well made and that are easy to wear all the time. And that's why I keep coming back to Quince. The fabrics feel elevated. The fits are thoughtful. Pricing actually makes sense. As I'm swapping out and I'm cutting, the few additions I'm making all come from Quince. Quince makes high quality everyday essentials using premium materials like 100% European linen. They're insanely soft, flow knit activewear fabric. Their men's linen pants and shirts are lightweight. They're breathable. They're comfortable. Basically the perfect layer for spring. The pants strike the right balance between laid back and refined. If you saw the video of me on stage at Retire Meet, those pants are from Quince. It was really cool. I came off stage and Christine Benz from Morningstar getting ready to go on behind me and said, love your pants. Not generally. I absolutely love them. I think they make me look put together without trying too hard. And they're flow knit activewear, moisture wicking, anti-odor, soft enough that you'll actually want to wear it all day. The best part is their prices. This is important, stackers. They are 50 to 60% less than similar brands. How? Quince works directly with ethical factories, cuts out the middlemen, so you're paying for quality, not brand markup. Everything's designed to last and make getting dressed easy, which is another thing I think we all want. I love those pants that I wore on stage. It's the cashmere sweater that every time I wear it, Cheryl goes, that is my favorite sweater on you. It looks great, feels great, and I don't have to have 50 things in my closet. So, like I am, refresh your wardrobe with Quince. Go to quince.com/SB for free shipping and 365-day returns. Now available in Canada, too. Go to QUINCE.com/SB for free shipping and 365-day returns. Quince.com/SB. You may not know that when we started Stacking Benjamins, it was a blog. And even then, just the startup cost, I remember thinking, is this the right thing? And what if I write things and nobody comes, right? Well, luckily, that didn't end up happening. But starting something new isn't just hard. It's terrifying. There's so much work. You're not sure whether it's going to work out. You're not sure if anybody's going to read it. And then we changed it to a podcast. Is anybody actually going to listen, right? What if nobody wants all the stuff that we have? Well, had I used Shopify, it would have been even easier, because with their expertise, their helpful tools, and their easy to use platform, that's something that would have made Stacking Benjamins more effective much, much more quickly. Shopify is the commerce platform behind millions of businesses around the world and 10% of all e-commerce in the U.S. Names you've heard of like Heinz and Mattel, Shopify, Gymshark, Aviator Nation, Allbirds, also all Shopify. Get started with your own design studio with hundreds of ready-use templates. Shopify helps you build a beautiful online store that matches your brand style. And best yet, Shopify is your commerce expert with world-class expertise in everything from managing inventory to international shipping to processing returns and beyond. And did I mention that iconic purple Shop Pay button? It's used by millions of businesses around the world. It's why Shopify has the best converting checkout on the planet. It also helps boost conversions, meaning less carts going abandoned and more sales for you. So you're stacking Benjamins much more quickly. Time to turn those what ifs into with Shopify today. Sign up for your $1 per month trial today at shopify.com/SB. Go to shopify.com/SB. That's shopify.com/SB.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's headlines.
Our headline today, okay, how many times have we said this line? Comes to us from Jason Zweig. I think we've said that 3 or 4 times.
Is he on staff here?
He's going to demand royalty checks pretty soon. Yeah. We are fans of Jason's. Of course, we're fans of a lot of people at the Journal, and we seem to have a few writers that just, man, they do a great job. And Jason, in this one, in his column, The Intelligent Investor from a couple of weeks ago, his headline is, "When all bets are off, all bets are on." He writes, "Fellow investors, financial markets work best when everyone knows the rules and we can generally trust other people to follow them. That doesn't mean we know what's about to happen, but we do like to tell ourselves it means we understand what is happening. That's why investors hate uncertainty," is one of Wall Street's most common cliches. But what's funny is, Jason writes, he writes, "Uncertainty isn't a rarity in markets. It's the norm." And it's funny because we tell ourselves all these stories that on a daily basis that we know the market went down 100 points today because of XYZ. We have no idea if that's actually why the market went down, but we love a good story. We love telling ourselves that this is exactly why the market, quote, market on a daily basis did what it did.
As ChatGPT would say, volatility or uncertainty is a feature, not a bug when it comes to investing.
It is 100% a feature. Jason says he wrote in 2008, "Investors hate uncertainty," in quotes. Well, that's just tough. Uncertainty is all investors have ever gotten or ever will get. From the moment barley and sesame first began trading in ancient Mesopotamia to the last trade that will ever take on planet Earth. If tomorrow were ever knowable with absolute certainty, who would take the other side of a trade today? I mean, this is really the key. Even when you're investing, is there somebody who thinks it's going to go up? And there's got to be somebody who thinks it's going to go down, which really means what? For you to decide which side of that trade you take, you actually begin doing some research and you start looking into, okay, what's the probability that this thing is going to happen? And I'll give you an example. What's the probability that your checking account is going to go down in value tomorrow? 0% chance. What is the chance that your checking account is going to keep up with inflation between now and 10 years from now? Also 0% chance that that's going to happen. So we begin looking at the bets here. Here's the scary thing though, OG, about betting is, so we look at January and the stock market. Treasury yields rose and U.S. stocks fell on January 20th because President Trump threatened to impose tariffs on Europe and didn't rule out using military force to annex Greenland. And then you saw on the glimmers of this vague plan for a greater U.S. presence in Greenland, prices bounce right back. You get all kinds of volatile things that happened in January. And yet we look at a double leverage rare earth ETF, which hypothetically might benefit, Jason writes, from economic development in Greenland. It went up 63% in a day and 100% in a week. Stocks in Denmark, at the time when we're calling Denmark, our leaders are calling Denmark names. You would think, Denmark sucks. Denmark ETF soars, goes through the roof, does better than the S&P 500 over that same time frame. Canada, of course, the president saying that Prime Minister Carney booted out of his peace plan. Canada stocks go up in January more than the S&P 500 does, even though we think that it couldn't. And in fact, when you think, okay, well, this is a Trump problem, anything that said Truth Social or was related to Trump, those things all went up more than the S&P 500 went up. This is all in Jason's piece. A new study of speculative financial behavior over more than 2 centuries finds exactly what anyone with common sense would have predicted. People take more risk when stocks go up and the economy is booming, and it can last surprisingly long. So there is this thing. What's the point here, OG? Is that the stock market's been going up generally. It's had its nicks and its cuts, but it's generally had this nice long run of going up. And the more it goes up, the more people speculate and the more wild it gets. Like, why are we betting on Denmark? Why am I betting on a Trump ETF? Why am I betting on what was it? Rare earth metals, 2x leverage. The betting escalates the longer the stock market goes up because we start feeling more and more, we feel more and more confident over time.
Is it that, or is it because people have more margin of safety? They're like, yesterday I had $100,000 and today I have $1 million. So
I'm betting the house is money.
I can bet $100K right now. And I'm still, if I lose it, I'm still good.
I assume that's what Joe meant when he said have more confidence.
Yeah, maybe.
Equals more money, more cushion for the push.
Well, yeah. I mean, it definitely makes us feel, I hadn't thought of that though, guys, that having more money would make me more confident because I'm so far ahead of the game. I can afford to take the bet. But on the other side too, I've been winning so much lately. Like there's been so much winning going on in my portfolio.
I'm really good at this.
Yeah. The chance of me losing. Well, does anybody lose at this stuff? We've warned people about this a couple times, OG, in the past couple of years. And in fact, about a month ago, we did a similar headline talking about gambling and about how scary this can be, this gambling mentality that people have. These prediction markets that we talked about at the beginning of January that were coming online and becoming more and more popular. And now I see, by the way, my social media feed nonstop, where you can bet on where markets are headed. You can bet like anything, like it's DraftKings. So you're not just betting on the NFL football
you
game.
can bet on any sort of thing that's in existence right now.
The boom in these markets, Zweig writes, I knew that these markets were booming. I didn't realize it was by this much. You can play short-term bets in just about anything. And these markets, Kalshi and Poly Markets alone, just 2 platforms. How much money do you think they're doing right now in weekly trading?
I would bet individually or together?
No, together.
It's got to be $1 million, $10 million, $20 million.
No, dude,
it's crazy.
It's more like 500 million. Come on. I see these ads like every time I finish playing a hand of euchre on my phone.
It's $1 billion. $1 billion a week. Just think about this. So this isn't even, quote, investing.
Well, none of that's investing at all.
Right, exactly.
No.
Yes.
And I don't want to call investing in Denmark betting. I don't want to call investing, in precious metals betting. If you are doing it from a trading standpoint, if you're saying, I think a great example, I saw this thing on Twitter or Instagram or something the other day. An investor, it was like on Unusual Whales or something. An investor had bet $30 million, levered 5-1, that the silver market was going to go down. Pretty big number.
Pretty big bet.
Pretty big bet.
Yes.
Now, that person, and this is, alleged. I don't know anybody who did it. It was just online, so it must be true. But I saw it the day before the nomination for the next Fed chair came out. And that day that the nomination came out, silver was down 27%. So this person bet on the silver market going down 5-1 levered. And then the next day, the silver market went down 27%. Okay. I'm no expert, but that's shady AF, right? That's not betting or investing. That is just pure manipulation. But if you're looking at something and you're saying, I think this company's going to do X, Y, and Z because of A, B, and C, and I'm going to make a short-term investment. I'm going to make a short-term purchase of that stock or a short-term sale of that stock because of this news. That's a bet. That's 100% a bet. But if you're saying, I need to be diversified and part of my diversification is to include smaller countries that I don't generally have in my portfolio because I have all my money in the S&P and I want to have some international companies. And because of that, I have a 2% position in Denmark. That's investing.
Sure.
A 2x levered ETF on rare earth metals the day before, the day after this press conference of, whatever. Okay, that's a bet. And you may win or you may lose, but don't confuse that for investing.
If we just lay down something definitionally to agree on, OG, which is that even though you don't like the term bet and I don't like the term bet, in a very, very broad way, everything we do is a bet. We're betting that the thing that I had for lunch is going to be cooked right. I'm betting that it's going to taste good. So I feel like there's these degrees of bets. And I love the definition. No. This is investing. This is betting. I totally get that. But even when we look at the S&P 500 over a long time, or, take what you said earlier, Denmark, I'm betting on the fact that Denmark is going to be around. I'm betting that the historical stuff that's happened with Denmark that I can use to make my decision will help me grok how this is going to help my portfolio in the future. I am betting that the instrument that I'm using is either diversified enough or to do whatever it's going to do in the portfolio based on a hell of a ton of information. So it doesn't have to be a huge leap, but I do feel like an investment in a single economy is still much more of a bet than an investment in the total stock market index, as an example. Like an investment in the banking sector is more of a bet. Even if I'm doing it from an investing standpoint, it still is more of a bet, I believe, than a broadly diversified across many sectors investment. And so I kind of see this on one end, I've got DraftKings and the Polymarket and all this craziness. And on the other end, I'm betting some economy somewhere is going to continue. So I do VTSAX, right? So I do the Vanguard Total Stock Market Index. I'm just going to buy everything because I'm betting that something's going to continue.
I don't like the word, but I'm not going to argue anymore about it with you. I think it boils down to time frame more than anything.
The reason that's important is because if somebody is new to investing and they're listening to us, you really want to do some calculations around probability, around risk management. Annie Duke said this, the poker player, when she was on the show, about thinking in bets. I want to think about probability. And the difference in probability with $1 when you invest in the S&P 500 versus $1 down at the liquor store at the Powerball or the Mega Millions, there's a huge difference in those bets.
Some of my best investing happens at the liquor store. I don't think I like where you're going with this.
That's not even the same thing. I don't think those are comparable in any way, shape, or form.
It's going to be use of $1. Well, no, they're not. You know why they're not? Because the probability of success is so incredibly different. Zweig writes, how should investors, as opposed to traders, approach these markets where you can bet on everything? I like his next line, OG, with a 10-foot pole and a hazmat suit. It's fine to do a little bit of speculative trading, he says, for fun in a mad money account, but never, and I mean never, mingle that with your long-term accounts. Isolate your speculation in a separate account on a trading app used only for that purpose. Give the account a nickname like Play Money to remind yourself this is the only place you'll speculate. Measure your gains and losses accurately so you don't kid yourself about whether you're good at it. But I think this is important. And the reason I love this piece is because for you, OG, it's clearly two different things, but that's because you're trained in this. To somebody who is brand new to investing and they go, oh, I could just bet on where the S&P 500 goes up and down today. Well, why would I not just bet on it one day versus betting on it long-term? Like, why would I keep my money around every day? That just doesn't seem to, well, it's because we know how it works. We know how the probability game plays, but a brand new investor doesn't realize the huge difference in probability. This is why when we answer your question, stackers, when someone says, well, should I get in front of this and put more money into AI stocks? OG will go,
that's stupid. Don't play that game. Don't do this.
And that's because your probability of success is so much lower. And the juice, not really worth the squeeze.
It's never worth it.
He says that about everything, though.
Don't do that. Link to this piece on our show notes page at stackingbenjamins.com. After the break, what we are going to look at is your different probabilities of success based on different investments that you may make. And some of these may be surprising if you're a new investor. So we're going to look at not things as obvious as the Powerball versus the S&P 500, but all the nuance when you look down that whole scale. That's coming up next. But right now, I think, Doug, you've got something that happened on today's date in history, right?
Sure do, Joe. Hey there, stackers. I'm Joe's mom's neighbor, Doug, and today we say happy birthday to an actor who's earned tons of Benjamins while starring in some of your favorite films like Creed, Black Panther, and Fruitvale Station. Who is this birthday boy? I'll be back right after I see if I can score an audition for the next Black Panther movie. I could play his brother by another mother.
Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. Built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you.
You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
Hey there, I'm Paula Pan. I help people make the smartest money decisions possible.
Do not ever worry about your salary. You need enough to make sure that you aren't in a bad financial position. Once you have that, your salary becomes moot. What matters from that point forward, upside gains. Any type of ownership stake or ownership potential, that's the money.
Remember, you can afford anything, just not everything. Afford anything. Follow and listen on your favorite platform.
Hey there, stackers. I'm budding actor and guy whose Hollywood dreams have been crushed because Joe's mom won't let me use the phone. Joe's mom's neighbor, Doug. I already told you, Ma. I used up all my minutes calling Miss Cleo. Jeez. Joe's mom ruins all my great ideas, but that's okay. That means I'm still here to deliver today's trivia answer to the question, who is today's birthday boy who starred in many of your favorite films like Creed, Fruitvale Station, and Black Panther? The answer, of course, it's a guy who's a big fan of the show, Michael B. Jordan. Happy birthday, Mike! And now, back to the money superheroes at the microphones. Well, I mean, at least they enjoy wearing tights. Joe and OG.
OG's big fan of wearing tights. And Michael B. Jordan, happy birthday, man. Happy birthday. Doug, you are a big fan. Do you see Fruitvale Station?
That's been on my list for a while because I know that is very well reviewed, well regarded, and I've not seen it.
You and I disagree on several movies. We won't disagree on that one. You will really like that movie. Yep.
Okay. Yeah, I got it.
Powerful movie. Good stuff.
Got to get that one to float to the top of the list again.
Yeah, but that list is always just so long, isn't it? It's like 50,000 things I need to see. The enemy is time. Speaking of time, let's do a TikTok minute. This is the time in the show where we shine a light on a TikTok creator who is either doing something brilliant or air quotes brilliant. Our theme today is probabilities and whether you're making good investments or bad investments. And what I love about this topic, OG, is even people you think should be really good investors share bad moments. This is a voice that many of you have heard before. A motivational speaker named Tony Robbins talking about an investment he made that might not have been as great as he thought it could have been.
Your worst investment?
When I was like 17, this woman pulled up in a brand new Rolls-Royce Corniche convertible. I was dumb enough to think I had a moment with this lady, right? So I talked to her a little bit, and I said, wow, what's your business? She goes, well, my husband's business. I was like, okay. Yeah, he's in penny stocks and everything else. I said, really? I said, well, dumbest thing you can ever ask. Got any tips? She goes, actually, we do. And I took $10,000, which at that time was a huge amount of money for me. I poured it all in this stupid speculation. And sure enough, it went up for about 2 months, and then it went through the floor, and I lost all of it. And that's what told me, you don't speculate. You learn to become an intelligent investor.
When you hear Tony Robbins say that, you're like, yeah, not a great idea. But it's the exact same line that we just heard Jason Zweig say in his piece. Yep, I am not going to speculate. I'm going to learn to play a longer game. And I think what we do, OG, is we look at these different asset classes. As an example, early on, I talked about how your checking account, a phenomenally safe place for one day, but over 10 years, you're going to lose your butt to inflation, right? The S&P 500, our friends over at Ritholtz Wealth Management, of course, both Josh Brown and Barry Ritholtz have been on this show. On a daily basis, buying into the S&P 500 is a bet because you win, according to Ritholtz, this is since 1950, you win 54% of the time. So, OG, in a given day, if you're going to put your money in the S&P 500, you might as well go to Vegas because it's pretty damn close to 50-50.
I mean, Vegas isn't 50-50. So,
I was going to say that's still better than Vegas.
But you are 5% better than the roulette wheel there, right? 49% chance of winning on the roulette wheel if you just play red or black. If you leave it in, though, for a month, right, that bet, which is 54%, becomes 64%. But if you leave it in the stock market for a month, you now have a 64% chance of that investment winning. If you invest for a year, what was 54% for one day now becomes a 79% chance that you're going to win. And that's in 1 year. And OG, I know you well enough to know, you know, if somebody says a 1 year goal, you're still not going to tell them to put money in the stock market. But if we're thinking in bets, I got a 79% chance that I will win that bet, right? That's still pretty damn good odds. But look at why we call this investing. We call investing in stocks a good idea when you get past 5 years, because at 5 years, historically, since 1950, any 5-year period, you came out ahead 93% of the time. Over 10 years, the bet goes to 97% of the time you came out ahead. And get this, there was never a 20-year time frame between 1950 and now, take any series of days you want, where you didn't come out ahead. 100% of the time you came out ahead. This to me is the point of what Zweig's talking about. Why the hell am I putting my money in these predictive markets gambling when I could put $1 in something where if I don't need the money for 20 years, I'm going to very easily make money. And I think a lot of new investors don't realize what a layup the stock market is over these long periods of time. And they're thinking, I got to get rich tomorrow, OG. I got to make this happen now.
Well, that's really the biggest issue, is recognizing that the benefit of investing is the compounding that happens over long periods of time. And the problem is that it's very difficult to see in real time that happening. Even to the extent that you have something that's a little bit more fixed or guaranteed, like a high yield savings account, 29 of the 30 days, you don't get any notification that you're going to get interest. It's just the 1 day a month where they go, we deposited $19 into your account for interest. You're like, oh,
wow,
sweet. And then you forget that the other 29 days, it's earning it. You just don't manifest it until that 30th day. You don't get to experience it until then. When you extrapolate that out and say, now you have something that, you know, you're going to put in your $1,000, your investment number, whatever it is. And if you happen to pay attention to it every single day, you get these wild swings of emotions from today it's worth $990 and I lost $10 to tomorrow it's worth $1,100 and I made $100. And then I'm back down to $1,050 and I lost $50. And now I'm back to $1,100. And it's not as good as the first time I got to $1,100, but it's still cool. And now I'm back down to $990. And that hurts worse than the first time I was at $990, because the first time I only lost $10, but now I lost $110. You get these wide range of emotions on a daily basis. And the best you can hope for is that $1,000, or the average, I should say, that you hope for is that $1,000 at the end of all of that chaos, 365 days later, is worth $1,100. And you go, la-di-da, I made $100 friggin' with all of that chaos for an entire year just to have 1 year's return of $100. But it's really not that. It's the stacking of those $100. It's the stacking of the $1,000. It's the stacking and compounding of it over time, which is the other reason when you do your financial plan and you put it in an Excel worksheet and you say, okay, I'm going to invest, for 401k maximum is 24,500. I am 26 years old, so I can max it out. I'm going to retire when I'm 66. That's 40 years. I'm going to say the market grows at 8% a year. I have $7 million. And you go, nah, that's not right. But wait, it gets better. That's putting 24/5 in every single year for 40 years. But what happens when you're 66 and you have $7 million in your bank account or in your investment account, right? And you don't touch it for the next 30 years. So for whatever reason, you don't need that money. You have other money, you have Social Security, whatever. Your 401k money, you just let sit. You retire at 66 with $7 million in the bank without thinking about it, guys. How much money do you have 30 years later?
Oh, goodness.
When you're 96 years old. First number.
In 30 years, it's going to double 6 times?
I said first guess.
Okay, fine. First guess, I'm going to say is 94 million.
Okay. Pretty close, like $80 million. It's inconceivable that you can tell a 26-year-old, hey, if you guys put $24,000 away in your 401k for the next 40 years, and then you retire, and when you die, when you're 100, you're going to give your family $100 million or $80 million or $75 million or $92 million. Like that we can't make those numbers check in our brains, because 24/5 a year for 40 years, $800,000, $900,000, whatever the number is. That's the power of compounding. It's the back end number. That's why Warren Buffett was worth $60 million when he was 50 years old. A hell of a lot of money, by the way. Yeah. And now is worth $100 billion at 90. That's the difference. 60 million is insane amounts of money. 100 billion is incomprehensible. You know what I mean? Like you can't even like fathom how much money that really is. But that's the compounding.
That's why the first $1,000 is harder than the second $1,000. Why the first $100,000 is harder than the second 100,000. That's why everybody says the first million, right? Millionaires like, oh yeah, the first million was hard. Then the second million just took off. It was like, bam, yeah. All of a sudden it's there. People going from 10 million to 100 million, yada, yada, yada. I want to take a look at these odds that we're talking about for stocks because you and I have seen, OG, people going, you know what? I'm not going to do that. I'm going to invest in a business because a business gives me a much bigger chance of success or a much, much bigger win. But again, we take a look at owning a business the same way I just looked at stocks. We can look at probability of success. Survival the first 2 years, 70% of business owners, their business lasts 2 years. So your goal, OG, when you start off is to have a business plan and have a business that's going to be in that 70%. 30% of you are going to fail, but 70% of you are going to win. When we get to 5 years out, though, instead of going up like the stock market where it gets better the longer you keep your money in, 5 years in a business, 50% of businesses survive longer than 5 years. And then we take a look at long-term success. If you survive that first 5 years, 69.5%, again, nearly 70% of those will last 10 years. If you can last 5 years, which is only 1 in 2, then you have a 70% chance among those people of making it to 10. And by the way, if you make it 10, 76.5% of those people will last 15 years or more. So there is this clear delineation that you can see. If you're going to own a business, if you're thinking in terms of bets, there's a much better chance that you're going to lose that bet. If you win, you can win. However, what do you see? In the stock market, we have to spend 0 time working inside that business. But for the average business owner, you're going to spend a ton of time. And based on these odds, those first 5 years, OG, I want to be in the trench because if I can make it 5 years, I've got a much better chance of making it to 15 years. But the only way that I'm going to make it 5 years is to spend a ton of time doing it. So this probability that owning a business is going to be a better bet than stocks, I think it depends on what you're actually solving for. If you're solving for more life, it's going to be difficult. And also the chance of success, not nearly as much as in the stock market.
Which is why the return's better.
Yeah, it can be better, but how many business owners do you know that are just barely making it? But you're right. I want to ask you about a few strategies because you were talking about all that volatility. There's some strategies that investors use sometimes to make the probability of success maybe higher. Dollar cost averaging, is that one of them?
No.
Dollar cost averaging doesn't make your chance of success higher.
Nope. Statistically, putting the money in as fast as you can makes your probability higher.
Yeah. Dollar cost averaging just evens out your return, stackers.
Well, it's just more realistic. It's like, what's better? Investing $24,000 in your 401k a year for the next 40 years or putting in $1 million today? Well, yeah, putting in the $1 million today is better, but we aren't given the $1 million on our 26th birthday.
Yeah.
Okay, here's your choices. You can put the $1 million in today and get it at 60, or you can do 24,000 a year for the next 40 years. What do you want to do? It's like, well, yeah, given the opportunity, I would put it in. If you have the choice to put the 7,000 in your Roth, or it's 7,500, I guess this year, if you do 7,500 in your Roth on January 2nd, or should I do whatever that is, 600, 500 and some odd dollars a month? If you can do the 7,500, do the 7,500, which by the way, is still dollar cost averaging. You're just dollar cost averaging annually instead of monthly.
Yeah.
If your cash flow doesn't allow that and you can only do it weekly, then do it weekly. The goal is to get the money in, not to be too precise about it.
Yeah. I think the lesson there, OG, is just don't hold on to cash waiting for a better day, right? Do it as soon as you can.
I hear people people say, oh, I'm changing jobs and I'm rolling over my 401k to my IRA, or I'm rolling my 401k to my other 401k, because I changed jobs. Maybe I'll wait to invest it. Like, why would you do that? Like you said, you got a 50-50 shot it's higher tomorrow anyway, and a 70% chance it's higher in a year. There's some chance it's not going to be. And by the way, it was probably invested yesterday when you had it in your old 401k anyway. So why wouldn't you keep it invested, basically?
But to your point early on, this does not increase your chance of success because if the underlying investment goes under, it still goes under. You're not going to win or lose based on that. What about using options?
Options are binary outcomes. You either are successful or are not. Options in the sense of trading them for purposes of making money, you lose more than you make for sure.
Yeah, I think 100% options can be used very conservatively.
Statistically, using options on the upside because you're worried about, if you're worried about the downside of a stock and using an option to protect the downside, there more times than not, the volatility will, get you out and then you miss potential upside, future upside returns because you're out of the market. So.
Well, that was my next thing, which is some people will try to use stop losses, right? And stop losses are these triggers that you set below the price that the stock's trading at now to try to prevent catastrophe. But so often people will set a stop loss, OG, to your point, and the stock goes down to the stop loss, the exchange traded fund goes down to the stop loss. You sell immediately, which, by the way, it's all programmed in, so you don't have to sit and watch it. It's put into a computer on your behalf. And then you're out of the position, and then it roars back.
Now you have $1 million of cash, and now you have to figure out when to get back in.
Yeah, and then it roars back. So options and stop losses, I think, are ways that you can get rid of the worst case scenario, but you also create a lot of worst case scenarios that would have never happened had you just decided, I'm going to stay in this for 20 years, like the statistic showed. Options, if I'm using them to protect against my downside. And what an option is, this could be, guys, an option to sell. So I've got this option to sell the stock market if it goes down, right? So I can buy that option. But OG, when you look at the price of buying that option, because it truly is, you're buying an insurance policy against what you have, the drag on that over time, I can't imagine how much money you're going to spend for this downside protection versus just going, you know what, I'm going to be investor for 20 years in this stock.
Yeah, options are trading instruments. They're not investing.
Yeah. I've got one more piece on this, which comes to us from a private wealth company, and I will link to it in the show notes. But I found this piece that was 5 key probabilities for investment success. Probability number 1, stocks are likely to be cash over most 20-year horizons. Actually, we just talked about since 1950, over all of those 20-year horizons. Key probability number 2, owning the market over trying to be clever is likely to pay off. The less you try to be clever, the better you're going to be. It's almost funny. We talked to George Newman, OG, a couple of weeks ago about creativity. And he was like, people get in trouble with creativity when they try to be clever. People get into trouble with stocks when they try to be clever.
Yeah. Don't.
Third, key probability number 3, diversification is likely to deliver a better outcome than concentration.
I disagree with that.
What?
I think it's going to more often deliver a better outcome than concentration. However, under diversifying can give you a bigger cha-ching at the cash register if you're right. If you under diversify, just don't be wrong.
Yeah. Yeah. Precisely.
Yeah.
You gotta be right.
Yeah. Key probability number 4, holding sensible exposures to well-researched risk factors should pay off.
It's a bunch of silly words all put together.
And not all equities have the same risks. So having sensible exposures to well-researched risk factors. In other words, I could buy a single small company stock, or I can buy the small cap index. The small cap index is a sensible exposure to a well-researched risk factor versus just picking 5 small cap stocks to purchase.
Okay.
Key probability number 5, if I'm looking at 2 investments that are the same, the one with a lower cost is much more likely going to give you more money. 100% of the
Did
time.
they literally just say much more likely to give you more money? Is that what they wrote?
Much more likely. No, actually,
you're just synthesizing that. Okay. Yeah.
I am synthesizing the
Yes.
words.
If they were the same investment and one is less costly, it will provide higher
100%.
returns.
I'll link to these on the show notes at stackingbenjamins.com. I would love to talk more about this either in our comments on Spotify or in our Basement Facebook group. And let's talk about thinking in terms of probability. But clearly, this betting that's going on, OG, driving me crazy. Just $1 billion a week.
Stop losing, and it won't drive you crazy.
Be better.
Start winning some of those bets. It's pretty fun.
That's probably the point. Doug, let's go out on the back porch because we've had some discussions lately around some of the episodes we've done.
Yeah, I can't wait to talk about this in particular because we have uncovered a whole bunch of stackers who are in the Costco love camp with me. We got a lot of people responding to our TikTok Minute back on episode 1795, where we talked about Costco, or the TikTok Minute talked about Costco.
And that minute, just for people that didn't hear it, was about the TikToker, David, said that people go into Costco and they think they're going to save money on a pallet of toilet paper, which they will, but there's so many hidden savings to going to Costco that he had never considered.
Yeah, right. Exactly. And then we got a couple of suggestions from Goers on Spotify. Goers says Costco travel is great for hotels, resorts, and cruises. I'll check the hotel's website and then Costco's. I normally save substantial money. And now you are dealing with Costco's cancellation policies and not the hotels. That's a big point.
Well, is it a big point? Because I don't know Costco's cancellation policy. Is it better than the hotels?
In most cases they are. And it's unusual because a lot of times when you go through a third party, if it's Expedia or it's worse. And the hotel just like backs away and we're like, sorry, not our problem. Deal with Expedia, which means you're not getting your money back. But Costco is incredibly strong negotiator for a lot of these things and typically have better policies around those things. Then Costco throws in a Costco digital gift card. Often if you book through them, you can and use it in the store and online. Last reservation goer says they got $97 gift card back.
Wow.
Yeah.
That's almost the cost of the executive membership is what, $125?
I think they raised it. It's like 135, 145 now, but it's so, I mean, you make that back so fast.
Well,
it's easy.
Just that $97 gift card alone gets you a huge part of the way there.
We got a great comment from Hope. Ditto on the travel. Also, the Costco credit card includes travel insurance. And if you have the executive membership, certain rental agencies give you an extra discount. They got an auto program that works with specific dealerships and finding used cars and new cars with less hassle, bigger discounts. You get a gift card there too, apparently. Hope also added you can get pet insurance and water service and other things. This is just one giant ad for Costco at this point.
Well, you've got the 2% executive membership rebate as well for all these expenses. So on top of that.
And I think I mentioned that back in that episode 1795, we just put every expense we can in our household onto that one Costco card. We get a sizable, I never go to an ATM for the year because you don't have to. You can get a direct deposit or you can get a gift card. Well, it's actually, I don't know if they give you the gift card over a certain amount, but I just take cash and I don't go to the ATM pretty much for the rest of the year because who really spends much cash anymore? But it's a great program, in my opinion. And then Hope also comments that Costco now has these things called business centers where you don't have to be a member. And they found out in her household that you can get some pretty inexpensive meat, obviously in bulk, but divide it up however you need to, cut it up, get it into a good Ziploc bag or whatever and freeze it. And you've got a big discount just using the business
I think she was saying that as a non-business member, you can still go in and buy from the warehouse,
right,
which includes like a lot of the same Costco stuff.
Yeah. So a lot of ways to save money, and people initially bristle at that membership fee, but man, you make that back so fast because there's so many other things besides just buying a gallon and a half of mayonnaise. And everybody makes that joke, but there's so many other ways.
I saw a piece this morning of Warren Buffett being interviewed, and he was talking about Kraft and all of the different products that Kraft has. Just think of Kraft and also how old they are, how in the zeitgeist they are, how many advertisements Kraft has had. They've been around forever. And Kirkland brand has been around for 23, 24 years.
Is that all?
What's incredible about Kirkland brand stuff, in the same categories where they compete against Kraft, they're beating them like 2-1. I don't remember the exact number, but it was close to 2-1. They're doubling the amount of business, Kirkland, on private label, where Kraft spends all this money on name recognition. Kirkland throws name recognition out the window and is outselling Kraft. Pretty incredible.
Agree. Why are we're having this major love fest for Costco, which is,
I don't know.
It feels too good to be true.
Know.
I usually get made fun
all
of.
over it. The stackers were all over it. What else we got?
Also on Spotify, Joe, Christian made a comment about our discussion about NASCAR driver Kyle Busch and his spouse Samantha. We did it. You might remember. I don't know if you do, if you're paying attention, Joe. We did a story about them back in episode 1792. I've got this eidetic memory for everything that we've talked about in every episode.
OG wasn't here for that one, and our friend Dana Ansbach took us through kind of how these IUL policies work so that we could look inside of them. But yeah, Kyle Busch and his spouse, Samantha.
They're suing Pacific Life, calling the life insurance that they bought, retirement fund, a scam. Christian says IULs should be illegal or at least treated like private investments and restricted to accredited investors. Christian went on to also agree with me about how ridiculous their kids' names are, Brexton and Lennox.
I don't remember this part at all.
Well, he just sent that to me directly.
Yeah,
Christian just sent that to me directly, but he was like, Doug, dude, you nailed it.
All right.
Brexton and Lennox, ridiculous kids' names. I think collectively they're called Brexit, maybe.
What do you think? That's where the whole Brexit comes from. We just combine the kids' names. OG, what do you think about that idea that IULs being illegal? That's one thing. That's like, okay. But IULs for accredited investors only. There's a piece of me that goes, you know what? These are complicated investments. When you look at the modified endowment contract rules, you look at how the inner workings of how you actually make money on these, how they work. It's so smoke and mirrorsy. It certainly seems to me that it's convoluted enough that accredited investor rules maybe should apply to IUL.
They're not investments, they're insurance contracts.
Yeah.
So you're never going to get, it's like asking the DMV to regulate the airspace of NASA. It's like a different thing altogether.
And that's exactly the kicker, because the story that Dana and I covered was how it was sold to NASCAR driver Kyle Busch and his spouse as an investment, as a retirement investment.
Well, yeah, but didn't they also not do their part of it, which was to put all the money into it like they're supposed to?
No, they did. They were told that they needed to
I read
make
the countersuit from Pacific, and to be clear, I'm not saying that they didn't get screwed on this.
Sure.
But Pacific Life is countersuing them, saying, first of all, you can't talk trash about us. You signed all this paperwork. You can't claim ignorance. Not only did you sign all this stuff, we also gave you 30 days to review it and then change your mind, which you clearly did not. And they're saying, again, I didn't dig into this at all, so I don't have any idea.
Yeah.
But they're saying, hey, this thing was illustrated as if you were going to put, I'm making the number up, $1 million a year into it for 30 years. You did $1 million twice and called it good, and then it blew up.
They did it 5 times.
Or whatever.
Yeah, they did it 5 times. And that was the Bush discussion, was that they were told they had to put money in it 5 times. And then when they got the bill for the 6th time, that's when they went, this is not at all the way it was explained to us.
Well,
and then Dana and I also went on to talk about this same stuff, OG, that we don't know. We don't know. And it's a complicated thing. And I can see somebody saying, you know what, this is a scam, or their friends telling them that it's a scam, when it's just so damn convoluted how it works. And you could also, because you've seen these illustrations, you could have a guy who's telling you something, you got to put this in 5 times, and having you sign a thing that is showing, I mean, heck, how many disclosures do you sign when you buy a car, right? We were just at the Volkswagen dealer, and it was amazing how quickly this guy's just shuffling paper. And he was so annoyed when I wanted to look at every page. He was so incredibly annoyed that I wanted to look at all of them. But man, when you buy these things, there's 50 million disclosures, waivers.
Not saying he didn't get screwed. I'm just saying, like, he had an opportunity to read it and review it.
Yeah. So to OG's point, Christian, if it truly is a life insurance policy, then it really wouldn't be subject to accredited investor status. The fact that it was marketed, this again, according to the Bushes, not as an insurance, but a investment, OG, that's always what makes insurance problematic. So we start crossing those two things together. Good stuff, Doug. Well, thanks everybody for those comments. We have had great chats on Spotify. We've had great chats in the basement, our Facebook group. Go to stackingbenjamins.com/basement for more of those. If you're here specifically, not because you want to talk about life insurance or about probabilities of stocks winning or being a business owner or, or these bet on anything platforms that are bringing in $1 billion a week now, you really want to put together a comprehensive financial plan. OG and his team are taking clients. So head to stackingbenjamins.com/OG. And that is the link to their calendar. That's going to do it for today, I think, guys. So, Doug, let's bring this thing home. What should be on our to-do list today?
That's right, Joe. First, take some advice from our headline. Betting? At least think about the odds that you'll win with your investment. That process alone would change how you think about your money. Second, if an investment could win big but you aren't sure and still want to invest, well, first, that's probably just a bet. And second, ask yourself if you'll still be okay if that bet goes sideways. But the big lesson? Don't give Joe's mom 2-to-1 odds she couldn't guess today's trivia question. Who knew she was such a big fan of Michael B. Jordan? I mean, how was I supposed to know that? Happy birthday, Mike. Join us Wednesday when we talk relationships and your money. Douglas and Heather Bonaparte join us with stories about relationships with your money, accountability buddies, or your partner. You're not going to want to miss it. This show is the property of SB Podcast, LLC, copyright 2026, and is created by Joe Saul-Sehy. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. And oh yeah, before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.
As we're recording this, Doug, just before we started recording, you wrote to me that we found out that Catherine O'Hara passed away.
We did. That one's a bit of a shocker. She was only 71.
And on Schitt's Creek, so funny.
Just nothing she wasn't funny in.
There was nothing she wasn't
funny in. Other
than
than maybe Home Alone, where she wasn't really supposed to be that funny. But other than that, wow.
I always forget that's her in Home Alone because she was such the mom, you know?
Right.
Yeah, she played the mom so well. She was part of the cast of the show that won the Golden Globe that you and I both thought shouldn't have, The Studio, Seth Rogen show, The Studio.
Yeah,
she was had a big part in that.
I mean, she probably deserved it. I saw 2 episodes of that, and yeah, she's good in it. She's good in everything. But you know, in Schitt's Creek or in was it The Mighty Wind? A Mighty Wind, the mockumentary, and Best in Show. Best in
Christopher
Show,
Guest.
where she's just a vixen, just a hussy, and everywhere she goes, she's bumping into guys that she slept with, and her husband just doesn't get it. Oh my God, it's just amazing.
And it's funny because you can't think of her without thinking of Eugene Levy. Like those two, you just think of, even though they do a lot of stuff separately, those two just from the beginning of their career coming up through SCTV for both of them, I think.
That's right. Yeah.
Yeah. And for our stackers that haven't seen the old SCTV skits, that took Saturday Night Live.
Which is pretty much all of them.
It took Saturday Night Live to another level. Just a whole nother level.
Right. Was it on like super late on Friday nights? It didn't go head to head with Saturday Night Live, I don't think.
It did not.
But man, that's where the Bob and Doug McKenzie skit comes from. There's a lot of stuff that made it into, I'll use your word again, because you were so proud to use zeitgeist.
Into the zeitgeist. Yeah. John Candy.
Yeah. John Candy and trying to think who else. It launched some pretty big careers and almost nobody saw it. I don't think.
No.
That was early 80s. That was Canadian.
So early, not that popular, and launched a ton of careers. But Catherine O'Hara, man, gone too soon.